Have we now reached peak hawkishness from the Federal Reserve? Well, all markets and all asset classes that I'm looking at on my screen have reacted very positively to the speech that Federal Reserve Chair Jerome Powell made today at the Brookings Institution in Washington, D.C., where he signaled that a moderation of rate hikes may be on the way. We're here to break down exactly what that means and what's next for gold, stocks, and everything else with Gary Wagner, editor of thegoldforecast.com. Welcome back to the show, Gary.
Thanks so much for having me.
A huge day for markets. The S&P 500 is up 3%. The NASDAQ up 4.5% following the speech that Powell made. Gold up 1%. Even cryptocurrencies are up. Gary, let's break down exactly what he said. Let's just get right into it. We'll play the first clip.
After our November meeting, we noted that we anticipated that ongoing rate increases will be appropriate in order to attain a policy stance that is sufficiently restrictive to move inflation down to 2% over time. Monetary policy affects the economy and inflation with uncertain lags, and the full effects of our rapid tightening so far are yet to be felt. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. The time for moderating the pace of rate increases may come as soon as the December meeting.
Okay. Let's just pause there and talk about what he just said. So he may moderate the pace of rate hikes as soon as the December meeting, which is coming up very soon. Gary, 0.5%, so a 50 basis point hike is now telegraphed. Why is he doing this? Why is he slowing things down?
Well, I think that the Fed realizes that they raised rates too rapidly to end what they considered a crisis, which it was inflation at 8%. Plus on the CPI, 6 plus in the PCE. And he realized that he stood a really strong chance of doing detrimental damage to the economy because of the rapid rate hikes. The key with me was that he said that it would be appropriate or might be appropriate to begin to moderate the amount of the rate hikes, but he didn't talk about the length because he still said that he's committed to getting inflation to 2%.
Okay. Yeah, he did say he will keep at it until the job is done. And I think the second part of the question is how long rates will stay high. Let's play the second clip.
It is likely that restoring price stability will require holding policy at a restrictive level for some time. History cautions strongly against prematurely loosening policy. And I'll close by saying that we will stay the course until the job is done. Thank you.
So I think it's important for investors and people watching the show to know that although he may be slowing, the Federal Reserve may be slowing the pace of rate hikes, Powell has not indicated he is reversing or pivoting and reversing policy to loosen policy anytime soon. So what do you think? Is that are we going to see higher rates for a substantial amount of time, for a long sustained period?
My take is yes. You have to listen to what Powell said, add that to statements by other Fed members, specifically the hawk in the room, which is James Bullard, saying that they're looking to get interest rates to anywhere between 5 and 7%. That was last week. And then he met with some people, did an interview saying that he believes that the monetary policy would be restrictive, not only through 2023, but 2024. That commitment to get inflation to their target. What they're saying is that they will continue to have a very aggressive and tight monetary policy, but they will tone down or ratchet down the amount of each individual rate hike, 50 basis points being what everybody is anticipating in December.
Okay. My investor friends have been asking me all afternoon, is this the beginning of another round of quantitative easing then?
I do not think so personally. I think that there was no mention of a pivot, as you just said. What there was a discussion in which there's a huge time lag from when they raise interest rates to how it affects inflation. So they want to slow that pace down, but they don't want to stop it. He never mentioned that it would be appropriate to either loosen, in other words, to ease what they've been doing, their monetary policy, but to not be as aggressive with the amount of the rate hike. I think it's going to be sustained rate hikes. I think we'll see a series of rate hikes between 25 and 50 basis points at every FOMC meeting next year.
Okay. Well, let's talk about the markets now. Markets reacted, as we've discussed, very positively. Why do you think the markets were taken off guard by Powell's comments today?
I think they heard what they wanted to hear rather than the nuances in what he said. In other words, the reaction was, yes, we're getting a 50 basis point rate hike rather than 75 basis points. But I think they disregarded his commitment to get the job done, the fact that it would take longer than they had originally believed. And when you combine that with statements from James Bullard, it tells me that we are not going to see an easing of their monetary policy. Rather, we will see an extension of tightening at a slower pace. And I think that market participants listened and heard what they wanted to hear, but disregarded the nuanced statements he made about the fact that they're going to get the job done and it will take longer. He never talked about a pivot. He never talked about monetary easing. So there's not going to be that type of scenario unless by some chance inflation really starts to ratchet down, which by all indications is not the case.
Yeah, let's talk about that. You know, he was talking about how he's going to stay the course until the job is done. Well, the job, technically speaking, is to bring down inflation to 2%. Do you think he's going to wait until inflation actually comes down to 2% before pivoting? In other words, what are the actual targets he's aiming to hit before a Fed pivot?
I think that it's virtually impossible that in the next year, 2023, they'll be able to bring inflation down to anywhere near 2%. I think that they will possibly pivot if they see inflation vis-a-vis the PCE, which is sitting at around 6%, go below 4%, 3.5%. That's going to be very close to their target, considering how far away they are right now. I don't see the Fed pivoting until we get the PCE in the fours in terms of where inflation is on any short-term basis.
Interesting. Now, let's talk about the jobs market now. The JOLTS numbers came out today. Job openings came down from the previous month. So I'll just read the first paragraph of the BLS report here that came out today. The number of job openings edged down to 10.3 million on the last business day of October. The U.S. Bureau of Labor Statistics reported today over the month, the number of hires and total separations changed little at 6 million and 5.7 million. So the labor market is getting tighter. Unemployment hasn't ticked up yet. The quit rates, and I'll show a chart here, the quit rates, the number of people voluntarily leaving their job, has been steadily trending down since the end of last year, but it's little changed since the previous year. Now, previous month rather. Interestingly, the BLS noted that the number of hires remained relatively unchanged. It said, in October, the number and rate of hires changed little at 6 million and 3.9% respectively. So job openings are coming down. Hires have stayed relatively consistent. Labor market is tighter. People are quitting less in fewer numbers. I guess that signals less confidence in the labor market. What exactly is going on right now? We're getting a lot of mixed signals.
Well, he talked about the fact that the labor market continues to be very, very tight in terms of jobs getting filled in any kind of a timely manner. He talked about the fact that over the last couple of years, because of an increased number of deaths, as well as people getting out of, he called it retirement, and you and I spoke briefly about that before this interview. When he talked about retirement, I think that a lot of people left during the recession period that haven't returned and don't plan on returning to the workforce in a traditional sense. And so I think that we'll continue to see a tight labor market throughout next year. And that is going to be kind of staying the course for the Fed. The Fed wants wages to keep pace with inflation. That's the whole idea of having a maximum employment scenario, is to have wages be enough to sustain those working class citizens that need to pay their bills. As goods and services, those costs have been rising.
There's another factor that he pointed to. I'm just going to play the clip here.
The second factor contributing to the labor supply shortfall is slower growth in the working age population. The combination of a plunge in net immigration and a surge in deaths during the pandemic probably accounts for about 1.5 million missing workers.
All right, so working age population slowing down, and he was blaming the pandemic for shortage of labor. Do you agree with these statements?
Well, I think that had something to do with it. Also, you have to realize that in terms of retirement, you were at the tail end of the workforce being compiled with a large percentage of baby boomers, those born after World War II. And that is where you're getting a lot of people gradually, but at a pretty consistent pace, leaving the workforce. And that's what he was addressing.
Gary, do you see a scenario in which the unemployment rate greatly shoots up in a very rapid manner before inflation comes down to anywhere close to 2%? And in that particular scenario, the Fed will be forced to do something more accommodative to fix the labor market, their second mandate. Is that possible?
Of course it is possible. I do believe that it is unlikely. And the reason is their commitment to bringing inflation down. Remember, years ago when we would have an interview, we would talk about the Federal Reserve's dual mandate, maximum employment, inflation at a target rate of 2%. We don't hear much talk about a dual mandate anymore. It's a single mandate. They are singularly focused upon getting inflation to a target that's acceptable and stopping the spiraling level of inflation that is still at, if not a 40-year high, a 30-year high. It's still at an area that many individuals in Canada, the United States, and worldwide have never seen. One. Two, global inflation continues to spike higher in many parts of the world. So I don't see that as a likely scenario.
Okay. Turning back to the labor market now, Jerome Powell did reference wage growth several times during his speech and during the Q&A period. He did say in previous months that the wage growth that we've seen over the last year was not a major contributor to overall CPI inflation. Now, I'm just looking at the Atlanta Fed wage growth tracker here. It peaked a few months ago at 6.7%. It's come down a little bit, but it's still high at 6.4%. Compare that to more than a year ago, which was 3%. So wages have more than doubled, according to the wage growth tracker. It's starting to soften a little bit. How is this going to affect the labor market? Are people going to experience significant real wage growth loss? I'm talking about nominal minus inflation.
Well, I think that when you look at wages and the data that they have, it's asymmetrical. In other words, it leans towards those in upper level jobs and middle and upper management rather than the mass, the top of the bell curve, so to speak, that's working at minimum wage or low wages. And his focus is upon having those at the top of that bell curve, those making minimum wage or low income earners, being able to afford the goods and services they need to survive. And that's the problem. When we look at those numbers, it's asymmetrical in that it focuses more so on those making a lot of money.
Okay. Turning now to the markets, let's talk about stocks before I want to talk about gold. So there is optimism in the stock markets. We've discussed earlier how I think people are omitting some of the nuances in Powell's speech. How long do you think this bullishness can continue? Let's suppose the Federal Reserve continues to hike rates by no more than 50 basis points. Let's say no more, 25 and or 50. Is this basically the bottom then for stocks?
That's an interesting question. I go back to an adage that one of my mentors taught me when I first learned about trading and being involved as a investor and a market participant. And that is, it's not a stock market, but rather it's a market of stocks. So there's going to be a select group that continue to do well in this environment and some that do not. Some of the luxury items are not going to be as in demand as the essential items. And so we have to look at stocks relative to what that company does and what that performance is. And so is this a bottom and will stocks go higher from here is a good question that I believe it's too early to answer. One thing we do know, and that is that the cost of borrowing money for these corporations to do mergers, to expand, continues to be a lot greater than it was a couple of years ago.
Yes.
I think that corporations have finally weaned off of their addiction to free money, which is what the initial move to the downside was in US equities. But now they're adjusting to interest rates that are more normalized, so to speak, when we're looking at 3, 4, and 5% in terms of interest rates. So the cost of borrowing is going to be the containing factor as to whether or not companies can expand and their balance sheets show profit.
Interesting. All right. Well, how does this translate to risk assets? And then let's talk about gold today. Now, gold's move today was significant. It saw a major bounce upwards, 1% on the day. And before we talk about the long-term outlook for gold, well, you have a great chart here we're about to show. Let's talk about today's reaction from the gold side. Was there an obvious reason for gold's bullish move?
Well, it was kind of a relief rally that they got confirmation that we wouldn't be burdened with another 75 basis point rate hike in December.
Yeah.
However, I look at what's happened this month and the month of October. In the month of October, we saw it leveling out, hitting really low pricing, around 1620, 1630.
Sure.
Just in the last month, gold has increased by 8% in value. And so you consider today's move 1%. It's noble, it's majestic, it is a strong move up. But consider what we've seen in November, which is not the bigger picture, it's still a microcosm. We're talking about the last 3 weeks. An 8% increase in the value of an ounce of gold is tremendous. And it's as strong as I've seen in a long time. And that we'll talk about that a little more when we look at our long-term chart.
It's interesting how the narrative of the Fed easing up on rate hikes is bullish for gold. One would think that this kind of signals indirectly and or directly that inflation is going to be under control. Shouldn't that, in theory, be bad for gold if you assume gold is a long-term inflation hedge? If inflation expectations come down, shouldn't gold come down?
Well, that's one way to look at it. The way that I look at it is a little bit the opposite of that take. And that is that they've talked about smaller incremental rate hikes per FOMC meeting. But they talked about maintaining a tight, aggressive, hawkish monetary stance for an extended period of time. That means that they're focusing on the fact that it's going to take a while for inflation to begin to unwind. It's not going to be overnight. It's a multi-year process. And so what that tells me is that market sentiment has pivoted. And I believe the pivot we saw occurred once we hit the bottom, I believe the last bottom price at the beginning of November, in which market participants began to focus upon the high level of inflation rather than rising interest rates. And that pivot is what has kept gold moving higher throughout this entire month. It's that while the Fed has a single focus on bringing inflation down, the fact of the matter is market participants realize that it's not going to happen overnight. 1, 2, it's not if, in my opinion, but when or how deep the recession will be when they get to their end game. But it's a fact that market participants are focusing on that inflation is going to be with us for quite some time, most definitely through 2023, but possibly into 2024. And that's what's moving gold higher.
Okay, let's take a look at your chart here. You've got a chart showing a number of lower highs all throughout the year. And finally, we've broken up and we've had a higher high, the first since March. Tell us about that pattern.
Yeah, if you take a look at this long-term chart, it begins at the beginning of the year. And the beginning of the year had incredible rally moving gold to $10 shy of the all-time record high, 2,077. But that's also the first rate hike that was initiated at the March FOMC meeting of 25 basis points. That was the beginning of the end. And what that led to was a multi-month correction that took gold from $2,077 down to $1,620, a tremendous drop. And on a technical basis, what we can see in this, I tried to point out in this chart, as the Fed was continuing their aggressive series of rate hikes, we saw a series of lower highs and lower lows. That is, to a market technician, the definition of a bear market. Obviously, when you look at the moving averages, I look at the 50, 100, and 200 day. I put them up at the same time. We were in full bearish alignment. We're starting to move into bullish alignment, but moving averages by their nature will always lag behind real-time data. But for the first time, this most recent high that we had, just shy of 1,800, I believe 1,791, was actually a higher high than the 1720, the last high that we had. So it was the first time since March that we had a higher high when compared to the previous high. Now, if the low that we saw of 1719 was in fact the low, and it certainly is panning out to be that way, considering that we're looking at gold at 1,782. That, of course, is the December. They're going to move into the February, and that's sitting a lot closer to $1,800 right now. The reference to 1782 is more to spot. The fact that we've seen a higher high and a higher low is significant, because that's the first indication. That's how it would look if market sentiment shifted from extremely bearish to bullish. Now, does that mean it will continue? We would need more data to confirm that fact, but I can tell you this: if we are entering a bull market, this is what it would look like.
A bull market sparked by a less hawkish Fed or something else, Gary?
A bull market sparked by the fact that market participants are focusing on the fact that inflation is still extremely high. And the Fed can deal with the demand side of many things, but in terms of goods and services, they can't control energy. They don't control the labor force, but that's different. They can't control food prices either. They can control the demand of certain items that people can choose to get or not, optional items, but the essential goods and services continue to, even the ones that are moving down slightly. Energy has moved down slightly. It's backed off of the $100 per barrel in oil. It's 78 and the 80s. But that's extremely high when you compare it to a year or 2 years ago when it was $50 and $60 a barrel. So I think what's going to fuel a bull market in gold is the fact that inflation remains sticky, it remains persistent, that the actions of the Federal Reserve have a tremendous time lag between the implementation and seeing that work out in the economy, and the fact that the Fed is not going to let their foot off the gas pedal, so to speak, until they get to an acceptable target. And I still don't think that target's going to be 2%. I think that if they get it around 3.5% in a year to a year and a half, they'll be happy as pie, so to speak. But right now, market participants are focused upon the fact that inflation is still exceedingly high. The CPI has come down, but considering the fact that what was the high, 9.1, and now it's in the 8s, the low 8s, and might even go into the 7s, that's still a level of inflationary pressure most individuals or any individuals that's under 50 has never seen before.
You're absolutely right, Gary. And actually, it's already at the 7.7%. So it's come down dramatically since 9.1. Now, final question for you, Gary. And gold outlook. Have you revised your outlook for the end of the year? And we're end of Q1 2023 in light of today's speech from Mr. Powell?
I updated my forecast for next year about a month ago, and it was based upon the fact that we hit what I'm calling that triple bottom, where it hit around 1630 to 1620 on 3 occasions, bounced off of it each time, and then had almost a parabolic rise up to that first top at 1791. I believe that by the end of the next year, we could see gold go and breach $2,000 again.
All right. Perfect. Gary, I appreciate you coming on the show on such short notice. Big day for gold, big day for stocks and markets. So I appreciate your thoughts and your time. Thank you.
Thank you so much for having me.
Thank you for watching Kitco News. I'm David Lin. Don't forget to subscribe to our YouTube channel and stay tuned for more.